Yeah, good morning. Hello, everybody, to our lecture Global Economics, and to go just through the things we have done last week. There we have talked a little bit about the situation of the global economy if we look at our little planet as a whole, how participate the largest country or contribute to what we then call the gross domestic product of our whole country, which is right now roughly around 110 billion US dollars. And not very surprisingly, still the United States are economically the largest country in the world with roughly 1/4 of global GDP. But as I mentioned it, the really very fast catch-up process of China during the last 20, 30 years, coming here around from 2% to nowadays almost as large as the United States, with which almost 20%, and the forecast is that roughly around 2030 that China will be measured in US dollars the largest country in the world, and that we also somehow see, I think I showed it here, a change during the last 30 years, that somehow Japan and China have changed roughly their positions in the contribution to global GDP, and that maybe somehow we are also in the situation that number 2 and number 4 also are changing its positions, and this is then Germany and India, where India is during the last 2 years has become almost as large as Germany in the contribution to global GDP. Yeah, and then we have also talked about especially the trends in global trade, that there we see a quite similar pattern, that especially China catched up, and here I have compared the 3 largest economic regions in the world, which are roughly of the same size: the European Union, the United States, and China, and that especially if we look at the imports and exports as an aggregate, that when we have a look at China, that there we have roughly a change, so to speak, in their policy, that they really catched up in the exports, coming from 2002, 20 years ago, from 6%, that they tripled their proportion of overall exports to 18%, that they also in the first 10 years of what we call globalization doubled their proportion of imports, but then that we somehow have a change, that they didn't start, or that they didn't went on to increase their imports. And yeah, this coincides somehow with the change of the powerful person in China, because around 2010, Mr. Xi stepped in and got into power. And what we see nowadays that China more or less now knows how powerful they are and that they somehow changed in a strategic way their policy. That they look that, so to speak, we are dependent on them, but they are not that dependent on us, especially on the EU and the US anymore. That they especially look at yeah, what they have, especially rare materials, rare metals, which we need in our batteries, which we need in our handies, in our electronic devices. There, they produce roughly 90% of world demand. But on the other way, they say, well, we don't want to import that much strategic products from the other two large regions, the United States and the European Union. And well, we will see how this will go on. And the last picture, we had a look on the development of global production and global trade. And there we saw this, what we can assign as, yeah, the time where the countries in the world became closer, that we have here almost a double speed of international trade compared to world production. So global trade increased by roughly 10%, while global production increased by 5%, and that after the financial crisis, we had the situation that global trade and production had a velocity which was almost the same. Then we have the turmoil of Corona. And right now, and we have to look at these numbers carefully nowadays, that even we see almost the same speed of international trade, but a little bit below of world production. And that also the speed of world production decreased a little bit compared with the situation before the financial crisis. So that we don't have only a slowdown of economic growth in Germany and the European Union, we have also a slowdown of world production on a global scale. And of course, here in November 2024, or then with a starting point in January 2025, we have Mr. Trump in charge in the United States. And I think everybody of you knows that he is not the greatest fan of international trade. He declares always in the opposite way that he loves tariffs to stop or to slow down international trade. And well, this slowdown, I told you, we do not see already in the actual trade numbers here on the frequency of monthly basis. And the latest data is until April this year. And this more or less means why don't we see this? That, so to speak, especially we in Europe, we traded a lot with the United States because we thought that the tariffs are coming. And therefore, we just put our products in the borders of the United States in the hope that we afterwards can trade these products because they are already in the United States. But we shouldn't be surprised when the trade numbers in the next months will be lower than before. Yeah, and somehow within this framework, you should have a look at your countries in your term paper then. And yeah, maybe you can, depending on what country you have, you can also have a look that you maybe compare this with the global trends. What are the economic trends within your country? And for this, you should have a look at the main indicators, the main economic indicators. And here, if you remember your macro course, then there we have this magic square, and we find it here, of course, unemployment, inflation, economic growth, and current account. And of course, there are many more interesting numbers you can have a look at. And this is, of course, interest rates. And there, of course, look at the central bank. Or at the interest rates of government bonds. And here, mainly as a benchmark for a country, you look at the development of the interest rates of government bonds, of the 10-year government bonds. And also, right now on the development of government debt, trade to GDP. This is called the so-called openness of a country. There, for example, Germany is, if you look at the largest countries in the world, then one can say that the openness of Germany is the highest or the largest you have. That for Germany, the trade to GDP ratio is almost 100%. So we are trading as much goods, exports plus imports, as our GDP is in size. And then, of course, have a look at the exchange rates, especially here. When you have a look at the exchange rates, of course, mainly versus the most important currency, versus US dollar. But then if you have a deeper look in your country, then of course it is interesting that you also have a look at the development of the exchange rate of the main trading partners of your country. And this in general would not be the United States. So, and also exchange rate with the main trading partners. Well, of course, and when you have a look at economic growth, there, please be careful. We have talked in the macro course a lot about this, that you distinguish between nominal and real numbers. And in general, when you are talking about economic growth, then of course you focus on the real numbers. And if you show some diagrams in your term paper that you also assign your diagrams. What are you definitely showing? That I see that you can distinguish this, especially between real and nominal numbers. Okay, and yeah, now I want to go through with you as an example through the German economy. Much of this you already know from the macro course, but we go through this with a little bit more detail. And yeah, for this, I think the time period you should start at 2008, so roughly the last 15 years. You should have a look at it, and there also then you will see this business cycle. As you, if you remember this, that we say roughly we can say one full cycle has a time period of roughly 7 to 10 years. And so maybe you see within your time pattern, when you look at your country, at the development of economic growth, maybe you see two cycles. But on the other hand, there is this turmoil of Corona, which we have around 2020 to 2022. And this, of course, is then somehow a break within the, so to speak, normal economic development. So, oops, and yeah, and if you look at it, I wrote it here that you should keep in mind if you show maybe the business cycle of your country and then you somehow want to compare it to the long-term trend or the potential growth, where we will do also little estimation when we are looking at the dependence between economic growth and unemployment in more detail. That if you say, well, on average, my country has a long-term trend of 2% economic growth, then a constant growth rate means that, of course, this is not a linear line, but it is an exponential function. So it is a left-banded curve. Yeah, and for this, let us recall what is this long-term trend that we say we roughly assume that this is somehow the long-term average, where we would say this is the potential economic growth in, so to speak, normal times. So if we look at the overall capital situation, production capital in your country, and also especially at human capital, so the labor market, and then we ask ourselves hypothetically, how much could we produce if all our production factors are fully employed in normal times? So if we produce at full capacity in the long run. But there, of course, be careful that this is, of course, a theoretical concept, that we cannot really directly observe this potential output, but we can estimate it, and a first shot estimation of this potential output would be then that we take just the average growth rate over the last 10 or 15 years. Yeah, here are some other definitions of potential output from the IMF or the ECB. So the potential output is the maximum amount of goods and services. This is what I called full capacity, can turn out when it is most efficient. Or here we see it at full capacity. Or looking at the ECB, it must be noted, and this I already mentioned, that we cannot observe it directly, but it has to be inferred from existing data using statistical and econometric methods. And yeah, we will do it today just by calculating the average, and afterwards I think we will start with this then next week, that we also can deduce potential output from a theoretical concept of the dependence between unemployment rates and economic growth rates. So then let's start with a simple averaging economic growth using, and there you should then, if you deduce the data for your country, that you really take then the right numbers when you are calculating such averages. And here I will use price seasonally and calendarily adjusted numbers. So the price, this means just that we take the real values, and since I will take here quarterly data, then of course, especially in Europe, the weather is changing, and for this, within 1 year, we have almost always within a year the same time pattern. That especially in the construction sector, we are not producing that much during the winter time. So we have a slowdown of the economic performance during winter time, and then an increase in spring and in summer. And therefore, then we are seasonally adjust. So we want to get rid of this yearly pattern of economic growth that we say, well, we can somehow average these quarterly data without this seasonally effect. And this is somehow done in the same way as we are doing this price adjustment when we come from nominal to real numbers. And the calendar adjustment, this of course we also need, and there is especially German a specific example that we have to have a look. When do we have holidays in your country? And if you look, for example, at Christmas, or in Germany at the 3rd October, if Christmas is lying on a weekend, then we do not have an effect on production. Or if the 3rd of October, this was this year on a Friday, so it's a working day. Next year we have a shift of 1 day, so next year it is a Saturday. So the 3rd of October do not have any effect of production because it's not a working day. And if you look at all these holidays, then you could have a shift of up to 4 or 5 working days when you are comparing 2 years. And yet then you can say we have roughly 250 days of work in 1 year. And then if you subtract relatively 4 or 5 days, because all your holidays are not lying at the weekend, but on a working day, then you have a relative decrease of economic growth of roughly 0.2 or zero point 0.3 percentage points. Only because of the reason we are working less. And of course, when you then compare 2 years and you say, well, we have a lower economic growth of 0.3 percentage points, and the reason for this is only that we are working less due to more holidays, then of course we wouldn't say that anything relevantly has changed in your country. And therefore, you make also this calendar adjustment. So if you want to take quarterly data for your country, then you have to keep in mind these 3 effects. If you take yearly data, then of course you do not have this problem. Okay, then I think I already prepared the data for Germany. So this is then the starting point, and at first we can then calculate the quarterly growth rates. And this, you know, is then the index divided by the index of the former quarter minus 1. And afterwards, since we want to average it, then you also know from my courses that averaging growth rates, in order to mathematically be exact, you cannot just take the arithmetic mean, you have to take the geometric mean, but you have to take the geometric mean not of the growth rates, but of the growth factors. So I then calculate also the growth factor, and this is just the growth rate plus 1. Yeah, and the average would be when we then take the full period here from 1991 until now, 1991 until 2025. This would be then just geometric mean of all growth factors, sorry, plus 1. No, sorry, minus 1, of course. This is very low. I'm a little bit surprised, but anyway. Oh, of course. This I know what I've done here. Let's take it in percentage. Do we have it? There. So a growth rate of 0.3%. This seems, and therefore I was a little bit surprised, quite low. When you remember it, for an industrialized country, we said that roughly the aim of economic growth would be in an interval within 1 to 3%. And yeah, what is the reason that we have here this very low economic growth rate? Well, of course, this is quarterly data. So this is the average growth rate from quarter to quarter. But this number, which we had in the macro course, was the yearly growth rate. And how do I come from an average quarterly growth rate to the yearly average growth rate? What do I have to do then? Because we have 4 quarters, of course, in 1 year. How do I have to manipulate now this number in order to come to the average growth rate per year for Germany? So the thought experiment is, what would be the growth rate if I'm growing every quarter with the same growth rate here, 0.28%, 4 times in a row? Any idea? Also in the internet? If you have a company, then maybe you have also your quarterly reports, and then you say your profits are increasing every quarter with 0.3%, and then you want to have your profit growth of 1 year. Yep. Almost. I think you have the right idea, not just multiplying it by 4. Well, if we would say that we are starting in the first quarter of 1991 with 100, and then we have the growth rate of 0.3%, 4 times in a row, then this would mean in the second quarter we would have 100 times 1 plus the growth rate. And this will be then always the same, almost always the same. So in the second quarter, we have 100.28, and then you have to multiply the 100.28 with again 1 plus the the growth rate, so 4 times, and then you would end up with a number of 101. So just multiplying 4 times in a row, 1 plus 0.28, and then afterwards subtracting again 1, you end up with the average growth rate. So if we want then to have the average growth rate, this would mean that, sorry, plus 1. So this, so the growth factor again, well, if you have later on a look at it, this would be the average quarterly, and here we want the annual. And this would be then just this number plus 1, so that we have the average growth factor to the power of 4. And to get again the growth rate, we have afterwards rising to the power of 4 again subtract a 1. And then we are here at 1.14%. Well, and also this would be always when you do your analysis of your economy, that you at first, just have a look at the diagram, how has developed your country. And here we have this very long time series, and then just by eye, we more or less see that from 1991 until 2000, you see we have roughly a constant growth here, and then you can also divide or to split your time period. And then, well, let's say here we then take just the average of the growth rate of 1991 until 2000. And if you have already calculated your numbers, then you can copy your formula. And if you want to start from 1991 to the year 2000, then it's here, let's say the 40, changing this number to 40, and also, this we can directly copy. And then you see at the first 10 years after the reunification, there we have a speed up of the economic situation in Germany. And then, I say then always a little bit funny that until the World Cup in Germany in 2006, we had, yeah, an economically weak period in the beginning of 2000, so roughly until 2005, and then we speeded up again until the financial crisis. So the next one would be then maybe here the period from 2000 to 2005. And again, let's copy this. And this is then from 41 to 2005 to 60. Oh, this one I have to copy. And there you see really this slowdown in economic performance. And if you find such periods which are really differing in the economic performance, then you can also have a look at it, calculate the quantitative numbers, and then look what has especially happened within your country. What was the economic framework during maybe 5 years from 2010 to 2015? What was special within my countries? And for Germany, this was really the situation where we had all these labor market changes because unemployment rates really increased. Right now we have 6.4% unemployment rate, and during this time we had an unemployment rate in Germany of 2 digits, I think roughly 11 or 12%. And okay, then we had really this speed up until the financial crisis. Let's take this. So 2005 to 2008. And then from 61 to and looking at this, then you have also to be careful, especially if you then go into the period of these very large crises of the financial crisis. And well, you should start with your countries from the financial crisis, but afterwards in Corona, that you do not incorporate by averaging your number these special Corona times, because there, in a minute, when we look at the data in Corona times, you see really this going up and down in quarterly growth rates. And here also you see quite large quarterly growth rates for Germany. And this is then the really upswing during the financial crisis, that even on a basis of quarterly data, here Q4 in 2008, you have minus 1.5% on a quarterly basis. Thus, this would mean more than 6% in a slowdown on a yearly basis. So let's therefore go then to 2008 Q1. This is 72 until 72. Again, the wrong formula. This one. So, and here you really see this were quite happy times of an average growth rate of 3%. And then unfortunately, we had the financial crisis. This, of course, averaging data, you should skip this period of the midst of 2008 and 2009 because this would then really, um, misspecify your averaging because everything is then focused only on 1 or 2 quarters. So let's take then the next one from 2010 until Corona. 2020. So the end Q1 is 80 and the first quarter you see already this is because of the first shutdown which we had already in the first quarter. So we then skip this Q1 or maybe we can also have a look what it would mean if we take if we incorporate these two numbers. Let's see until Q4 this is 119. Or let's say here 2019 Q4. There we have this quite good economic growth rate, average economic growth rate of 1.5. And if we just increase this to then, and here you see how careful you have to be. So we are averaging here. Well, let's take this as an example. So this is an average of roughly 10 years. And if we increase this averaging process of 10 years, so 40 quarters, just with half a year, so 2020 Q2. Because of the shutdowns during Corona times, you see that we just divide the growth rate by 2. That the average growth rate went down only by the performance within this half year of the 10-year average by 50%. And this is then, of course, hard to interpret this number then on a long-term averaging process if this number is mainly driven only by an event within this half a year. And therefore, of course, one has to be a little bit careful looking at these numbers. And as the last period, and this is not very funny for us in Germany, that we hoped that there would be an upswing after Corona. So the end of Corona, 2022, Q1, 128, and the last one, 141, 128. Until 41. Well, and this, of course, is right now our very large problem in Germany, that we have to admit that we are within a deep, yeah, structural crisis in our economy. That we could say, or that we have to admit that really our potential growth has dramatically slowed down after Corona. And also we have to admit the main reason is not the turmoil of Corona, but the main reason is our, compared to others, our bad infrastructure. Also when we look at our educational system. So the main drivers of economic growth do not look very well in Germany right now. And this, unfortunately, we see directly here in the economic performance during the last 3 years. Okay, and yeah, I would recommend that especially also you can then make a comparison for your country. What was the performance before Corona? You do not have to look very deeply into what has happened within Corona, because during this time we just followed the epidemic numbers. And but what is especially the economic performance after Corona, within these 3 years? Okay, so this was just when you have a look at the numbers, that you have to be a little bit careful by averaging. So, and as a recapitulation, this picture you have also seen in my macro course. And well, do you remember that we can see some historical events just looking at the economic performance? So these are always here time periods on a quarterly basis where we have where we had a shrinking of GDP in Germany. So in the 1970s, what has happened there? Roughly 1973, 1974. The internet? Any idea? What was the reason of this quite dramatic slowdown in economic performance? Yeah. Yes, this was the first oil crisis. The OPEC was founded, I think, in the 1960s, and then they the first time said, well, let's see what happens to the world if we do not sell anymore the most important good in the world, oil, to the other countries. In Germany, especially, we had then by law that it was forbidden to drive on Sundays. Autofreie Sonntage hieß das damals. And the people were then walking on the highway. And the second, in the 1980s, in the beginning of the 1980s, 1980, yep, yes, second oil crisis. And the reason was not that the OPEC country just said we do not sell our oil anymore, but what was the reason of this second oil crisis? Yep, yep, yes, definitely. So second oil crisis, war between Iran and Iraq. Well, this is now almost 50 years ago, and still we have the problems which has arisen from this event. Number three. Yep. Yes, this is the reunification of Germany. So first, everybody was very happy, but economically, in the first 2 years, it meant that, of course, we had this five new Bundesländer increasing the German Federal Republic of Germany. And in order to start the rebuilding of this part of Germany meant an economic slowdown. Reunification. Oops. Well, on the other hand, you see then here, starting roughly from 1993, we have a quite good situation, and this we saw here also in the numbers. This was this time period until 2000 with an average growth rate of 1.6%, which is quite okay. But then what happened? Number four, as actually this were more or less two historical events just within 1 year. Yep, 9/11, and economically this was 9/11 2001, and economically it happened just 1 year before that also. Something which slowed down the economic performance on a global scale in the year 2000. This was an economic event. This was a crash of the stock markets worldwide, and this is called the so-called dot-com crisis. So this is then 2000 dot-com crisis plus 2001 9/11. Well, of course, I think we can go through this a little bit faster Number 5 is then the financial crisis. 6 is Corona. And here you also see, if we compare this with the former crises, that especially the downturn and the upswing in absolute numbers in the financial crisis is much larger than the former so-called large crises. And during this time, I was in the scientific staff in the Council of Economic Experts of Germany. And during this time, we thought, well, this is really unique what happens here within this financial crisis. This we haven't seen before, or we have to go back in time 100 years to the world recession in 1929, 1930. And just 10 years later, we had Corona. And here you see the scale of -3 on a quarterly basis up to +5 is not large enough to show what happened during Corona within the yearly time pattern. So we had a down and an up of almost plus minus 10% during this time. But if I would show this in the whole scale here, then I wouldn't see anything else, because all the other numbers here would then really shrink down. And this you should also keep in mind when you are showing some diagrams, that you are using here a scale where you can really see something. Of course, if I would take here plus minus 10%, the information we see is still the same, but by eye, I don't see anything anymore. Okay, well, and 7, a lot of events, Ukraine, Mr. Trump, the change of Chinese policy. This would be then the framework, the economic framework, where Germany is now developing, but we also have to look at ourselves, not only seeing the reason coming from outside that we have a bad performance, but also to have a look at ourselves, because I think somebody has Poland chosen, is you? And there you will see that after Corona, Poland performed much better than Germany. And I think I told you, maybe you can compare this a little bit, because during the last 15 years, Poland and Germany formed somehow an economic bloc. And maybe there you can also find the reasons. What is better in what are the reasons that the performance of Poland is that much better than the German performance. Okay, so especially for you, it is then this period here, and maybe you can then see also some of the events in your data. Okay, this as a starting point, and now I want you economic growth. I think we can skip because we have already done this. Let's copy these numbers here. And let's go to the next one, inflation. And yeah, in order to get prices or interest rates, then of course the central bank of your country would be a good source. And here I take the German Bundesbank. And if we click on this, then you see here this is the CPI, the Consumer Price Index, on a yearly basis. When you want to have a look at the actual situation, then this frequency wouldn't be the best choice, and therefore, oops, how is it this now possible here? Going back, and the next one here is done on the monthly basis. So let's download this. And inflation. Let's copy these numbers. Oops, you can find it. So if we have the index of the CPI, how do I obtain then the inflation rate? Maybe you find also a time series for your country where you directly get the inflation rate. But yeah, if you do not have this, when I have the index, let's say then here in March 1992, if the index is 64.5, what would have been then the inflation rate of Germany? How was the inflation rate defined? It was the change of the consumer price index. And now you have to be careful, on a yearly basis. So we have done to compare the consumer price index of March 1992 with the consumer price index of March 1991. So in order to obtain the inflation rate, we cannot calculate the inflation rate of with these data of January because 1991, because then we would need the consumer price index of 1990. And this we don't have, so we can then just start with January 1992. And this again would be then index of 1992, January, divided by the index of 1991 minus 1. And with this we can then go down. And percent. Oops, this is a little bit too much. This really 6% during this time. Okay, I'm a little bit. Oh, this is just reunification. This was a push of reunification. But now I will start from 2008 because this is then the period you should have a look at. So, how do I do this then? Taking this. Oh, he just fetches automatically the data. Then what do we want? We want the inflation rate only. And we want to start. Okay. We want to start from 2008. This is then 208 until 420. So starting from 208 to 420, and here also from 208 to 420. Here I did something wrong. 208, this is okay. Maybe I have to, and also, what is wrong? Oh, I changed the wrong time series. Now it should work. Yep. So this is the inflation, and then, yeah, you should have a look at the development of the inflation rate of your country, and then, yeah, just describe what has happened. Of course, here with this almost 0%, this was the financial crisis, and yeah, this also we can, of course, explain economically. We had this really crash of demand, and if the demand goes down, just remember your market diagram. If demand goes down, we should not be really surprised that also prices decrease. And this would then end in a slowdown of inflation. Then we had here roughly this situation of a quite low price development. And yeah, if we ask then in Germany we can say that, yeah, more or less the economic performance was quite good between the two crises. And there we would then expect a little bit higher inflation rates because the economic performance, when this is quite good, this would mean high demand. Why don't we see then an increase of inflation rates? And remember, during this time, although the economic performance was quite okay, we were within the European Monetary Union and we had the euro crisis, so all countries around Germany didn't perform that well. And we have also that we are within the European Monetary Union, and therefore the monetary policy was not only made for Germany, but for the whole monetary union. And this is then maybe also an explanation why we don't see that high inflation rates. And it was also a situation where we had overall not very high inflation rates in in every countries, in all countries, and even the central banks tried to push inflation with very low interest rates. But this hasn't happened. But then here, after Corona, we had this really increase of inflation rates. And yeah, this was not only the effect of the Ukraine war, but also that after Corona, we restarted to consume. And there maybe you can also have a look at the development of the savings rates within your country. So in Germany, the savings rate went up from roughly 10% to 16%. The reason was just it was forbidden to consume during Corona times. So on average, the population in Germany have saved too much relative to their own preferences, and then we just restarted to consume. So this is then a push on inflation. And also, if you remember this, after Corona, we had really two problems after we restarted to trade to get the products as fast as we needed them. And additionally, then of course the energy crisis due to the Ukraine war. So, so maybe then increasing demand, shortfalls in trading needed products, and of course the energy crisis because of the start of Ukraine war. Well, and this took almost 2 years, and now we are roughly back on track on the aim of what we have. You know that the aim of the European Central Bank is 2%. And so maybe this would be then also a good idea to put the aim of, oops, we are almost through, but let's take this and then we end for today. Yep. Uh, Data and oh, this is the wrong one here. Ah, how can I come this so it's possible? What's wrong here? Then again this one and this one. No. Uh, let's try it like this. Now it works. There it is. And now we have here also the target of the central bank in our country here. So this is inflation target of the central bank. And there you should also have a look at your country, at your central bank, and maybe you find an inflation target and then compare this with the development of the inflation rate with the target of the central bank. Okay, so thank you very much. And we go then on next week with some data for Germany. That's it.